While computers may have changed modern markets for investors themselves, they also had a very significant impact on what was going on behind the scenes. Effectively, computers were able to revolutionize the plumbing of financial markets, by enabling better records, faster communication, automated execution, and more competition among market makers, as I discussed with the introduction of the NASDAQ. One of the other advantages that we saw was the creation of central clearing counterparties in the latter half of the 20th century to help to alleviate the expanding paper crisis, which involved having to shut markets down earlier to enable all of the clearing accounting to actually take place. Now, domestically, all of the clearing in Canada takes place electronically via the Canadian Depository for Securities, which is the custodian of over $4 trillion Canadian worth of securities. When we trade over the stock exchange is effectively a GUI, or a graphical user interface, that allows us to connect to the clearinghouse where transactions are actually being processed, and where the title to securities actually changes over. In the United States, the equivalent is what they call the Depository Trust Clearing Corporation, or DTCC, which handles quadrillions of dollars in annual turnover, which, for those who might not be aware, is millions of billions of dollars. Now, to understand how central clearing parties work, the members are all sharing in the overall counterparty risk of trading with one another. And they try to limit the risk that they face when dealing with each other by pooling all of these risks, effectively making the clearinghouse the counterparty in every transaction. Individual members of the clearinghouse don't actually directly trade with each other. Both trade with the clearinghouse itself. And that means that in order to protect against non-payment, the clearinghouse requires its members to have certain kinds of collateral requirements. And the members of the clearinghouse are actively monitoring one another's creditworthiness to make sure that they aren't exposed to an unusual default. Now, another thing that's happened has been the consolidation of the stock exchange space. Whereas once the United States had dozens of exchanges and Canada had 5 different exchanges, today Canada has just 2 major exchanges, the TMX and the new entrant NEO. What we've seen largely has been a consolidation of stock exchanges, both within the North American market and within the European market. There's also been a move towards having continuous access to 24-hour trading. As European markets are closing down, the New York market is opening. As markets in New York are closing, markets in Asia are beginning to open up. And so this may eventually enable access for computers in particular to engage in multi-market 24-hour trading. Now, of course, there is some pushback to this. For the most part, critics are worried about a loss of national control. And this was the case in 2011 when the London Stock Exchange made a bid to buy the Toronto Stock Exchange, Canada's TMX group. Ultimately, this bid was defeated by a domestic bid by the Maple Financial Group, but you'll have a chance to explore that during your case study. When we take a look at the idea that a stock exchange is really just the interface that people use for accessing a clearinghouse, we start to understand the development of things called alternative trading systems in the European market, known as multilateral trading facilities. These offer non-exchange-based trade matching, effectively enabling large investors, generally institutions, to trade with one another without actually routing their trades through the stock exchange itself. Still runs through the central clearinghouse, but does not actually go through the public exchange. Now, you may have heard a variety of different terms used to describe these. Electronic communication networks, for instance, are what we would call the all-computer subset of alternative trading systems. Most ATSs are electronic communication systems now, but not exclusively. You may also hear the terms crossing networks and dark pools. These are all effectively the same sort of idea. They are private pools of liquidity that allow institutions to match their trades against one another so that they can move large blocks of sometimes hundreds of thousands of dollars or hundreds of thousands of shares without necessarily having to force it through the order book in the market. This, of course, would drastically upset any kind of price equilibrium, which had been established on the basis of the information that various traders had, as opposed to being dominated by the waves created through trying to sell or buy a block of 100,000 shares. Now, of course, in the early years of these kinds of private pools of liquidity, there were a number of problems, including the people operating the pool reselling what had been considered to be proprietary data about their clients to yet other people. But ultimately, regulators stepped in and tried to enhance their enforcement in these otherwise private pools. And this has led over time to a reduction in these kinds of conflicts of interest. But perhaps most astonishing has been the way that high-profile investors have computerized their trading strategies. We've seen a very significant change in the last 40 years from the manager-dominated fund, where a manager might have particular views or insights on what's going to happen, being replaced with quantitative analysis conducted by supercomputers, who are effectively racing to complete trades before one another and to analyze data and changes in the market at lightning speed so that they can be just a microsecond or ahead of other traders in the market who are looking to profit from sometimes just tiny little mispricings across different exchanges. This has also led to the creation of what we call high-frequency trading. In high-frequency trading, what we have are computerized market makers that are effectively trading as quickly as possible to try to match orders, sometimes trying to get in ahead of other orders that are moving through slower systems. Most of the high-frequency trading firms are what we call market makers. But of course, the problem with high frequency trading is that if you are even just a few milliseconds or microseconds behind another competitor, you lose money, which has turned the process of making markets away from one that's an informed auction being made on the fly by a human who is attempting to balance their inventories with order flow, to one in which a computer does all of this in an emotionless lightning speed, with emotionless lightning speed rapidity. The problem is, of course, that relying on computers to do the right thing doesn't leave a lot of space for when there are errors. For instance, in 2012, Knight Trading, a high-frequency trading firm, lost $440 million in just 45 minutes due to a malfunctioning trading algo. Literally every minute that trading algorithm had been turned on, the company lost $10 million. And so there are real concerns about whether or not these kinds of high velocity trading activities are actually creating value for us. Some arguments have been made that they are simply increasing liquidity in the market, that we are increasing competition in markets, but others yet have suggested that in the battle to be the fastest high frequency traders or high frequency market makers, what we've actually seen is predatory behavior by some of these high frequency traders attempting to game markets in ways that that regulators have otherwise tried to disallow for non-light speed computers. This battle continues. One of the interesting innovations we've seen in this space was actually brought up by Brad Katsuyama, who estimated that his clients for his stock exchange would actually be better served by having a speed bump put in place that would slow down all orders by simply having massive coils of cabling that they had to pass through, which would negate any of the advantages high-frequency traders may have had over one another. Needless to say, the design of stock exchanges is going to continue to evolve as computers evolve, and so it'll be important for us to consider how the evolution of the stock exchange actually pairs with what we hope to accomplish with a stock exchange, which is capital formation and liquidity for long-term investors.